So we're getting cuts on both sides of the border, the US and Canada, often good for the stock market. Our guest thinks that stocks aren't that cheap. Let's get more from Brian Szytel, Co-Chief Investment Officer at the Bahnsen Group. Thank you very much, Brian, for joining us. Now, if I understand you correctly, you think that there's a fairly high bar for stocks now. Investors will want to see consistent earnings.
I do. I think that where profit margins already are historically very high. And so the bar for both the valuation, where multiples already are, and what they're going to have to achieve over the next 12 months to just maintain current levels, I think is substantial. There's plenty of parts of the market, I think, where there is value. But as far as broad indices, I think the returns will be a little more muted going forward than they have been the last, call it 3 years in a row.
Though so-called risk assets, and I know it's a broad category, you're generally positive on that. Do you mean prominent growth stocks, for example?
Risk assets, I would go across the spectrum. I would look at equities. I would look at fixed income as well. Generally speaking, when you have credit spreads this tight, you have a fairly healthy tension between growth in the economy and inflation, and now where Fed funds will start to head down to. I think you can be constructive on risk assets. I just think it's better to heed the valuation of components of where that is and play in those sectors that are a little more reasonably traded.
Is it clear that the Fed can avoid a nasty downturn in the U.S. economy?
Well, that'll be yet to be seen. So far, so good. You know, I mean, they have an inflation number that is estimated to come down towards the mid-twos over the next 12 months. And if you think about a real Fed funds rate of maybe 1%, meaning 1% above inflation, that gives them to a 3.5% level, and that's already where dot plots are estimated for 2025. So there's not a lot baked in to continue to lower rates next year. They're going to do a lot of that on the front end. And like I said, the setup for this is still more constructive than otherwise. But of course, as we know from history, things can change.
Tell us about energy. You feel that there is the opportunity to buy some stocks cheap there?
I do. If you look at all the sector performance for this year, you know, energy has lagged along with some others like real estate and utilities and staples and healthcare. But the energy sector is interesting to me because that midstream space, you can get great dividend yields, great growing cash flow dividend yields, reasonable valuations. And if you juxtapose what you can get in both Canada and the US between partnership and C Corps, I think there's a good way to get some both growth of income, but then also appreciation in the names as well.
Beyond the Mag 7, what about sectors, big cap stocks? Where are you seeing opportunities?
Those other sectors I mentioned, I think if you look over the next 12 months, and again, if this tension that I've talked about remains somewhat healthy between growth, inflation, and labor, then I think you'll get something more earnings growth related in the broad indices. But if you could look at some of the more, I guess, underappreciated or underloved parts of the markets, call it staples, healthcare, energy, you know, you can just enter at a more reasonable valuation. And I believe you'll get some catch up to some of those other components of the market, particularly technology, over the next 12 months.
Do you feel, is there speculative froth in the market right now? I'm thinking about things like meme stocks and stable coins and a bunch of crypto IPOs, for example.
There is, and you know, those are all shiny objects, and I get when there's a shiny object angled out there, people are drawn to it, and eventually it'll end in a bad way. But as far as when that will be, maybe it's 25, maybe it's 35. You know, I can't speak to that. But from a standpoint of a sensible investment standpoint, I think that you need to assign some sort of an intrinsic value and invest with the purpose rather than just chasing a shiny object.
That's interesting. So broadly speaking, you're skeptical of these crypto innovations that we're seeing?
I don't know about skeptical. I just think that the early stage and where the valuations are, which are basically an infinity sign, and most of the companies that aren't earning real free cash flow yet, is, you know, very susceptible to downturn. So, you know, for a small percentage of someone's net worth, if there's speculation, I suppose there's always room for, you know, 2% or something of a portfolio. But from the standpoint of what is going to drive an outcome for most investors, I don't think you're going to get there by betting, in other words.
Right. Tell us bonds, what broadly, let's put up the US 10-year bond yield. Say somebody's time horizon was 5 years, and they wanted to be ahead, net ahead on principal and interest. Would the US 10-year bond be a decent buy right now at the yield of about 4.1%?
Yields have come up here. We actually broke 4% on Fed Day and then rallied back up a little bit after that. But yeah, to answer your question, I would say that there's a reasonable rate of return to be had. If you think inflation is going to average somewhere in the 2s, and you think of a risk-free rate somewhere now in the, call it low 4s, that gives you a positive real rate of return for something that doesn't have risk of principal. And I think that's reasonable here over the next couple of years. 5 years, a little more murky out, but if you looked at maybe 2 years, I think it's a reasonable trade-off.
Right, and just remind us, you may have touched on this, and I'm not sure if this is on your radar. What about credit spreads? They have been very tight on US bonds. In other words, people willing to take more risk in the States on corporate bonds than they often have in the past. Is it still a very buoyant corporate bond market?
It is for now. My point with credit spreads would be that I think they're a good indicator of underlying strength in the economy. Okay, so if you look at where labor is, that's more or less my litmus test on where I think if labor starts to fall out of bed more, I think credit spreads will start to move out a little bit here, more than they are now. But for now, there's very little risk priced into the high yield corporate bond market, and I think that is an area that seems rich to me because of that.
Thanks very much. I really appreciate you joining us today.
Thank you.
Kicking off Friday for us there, Brian Szytel, Co-Chief Investment Officer at the Bahnsen